Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video I decided to go ahead and do a short little video series on strangles. And strangles is a strategy or a method, a technique that you can use with stock options on a stock that you think is going to move up or down. You don't know which way, but you believe it's going to go up or down. Maybe it'll go up 5% or 10%, we don't know, but you think it's going to go up or down. So in this video I think I'm going to break it up into 2 or 3 parts. In this video I'm going to go over the basics of a strangle and what is a strangle and why do we do strangles and how you make money on it. And then in the next video I'm going to show you something that I did, almost like a schedule, almost like a 9-to-5 job that you can do on a weekly basis. And I made a little watch list of 100 most actively traded stocks with stock options. And then in the last video I will go over some strangles that I did recently, just in the last few months, and I did it on 3 different stocks and I made money all 3 times. I didn't make millions, but I made several $100s, and so I feel good about that, and I thought, share the wealth. Lots of people out there selling their silver bullet system, you know, buy my course for $1,000. Me, I put all this out for free. So here we go. So the first thing you want to do is you want to find a stock that you think is going to go up or down. So let's do that. Let's go to Google search and let's put in earnings calendar. Earnings come out on stocks, on companies, every 3 months, and that's a good way to find a stock that's going to move, because if the earnings are good, it's going to go up. If the earnings are bad, then it's going to go down. And yes, there are exceptions. Sometimes a stock doesn't move, but most of the time it does. So it's a good bet to put on a strangle maybe a few days before the earnings. So let's go to next week. This is Yahoo calendar, and let's go to Wednesday, about the middle of the week. Today is Wednesday, a week before, August the 15th. And let's click on the 22nd, and these are a list of the stock that have their earnings on the 22nd. And here we have Target, here we have Lowe's, Sears, some companies I've obviously heard of. I've heard of Momo. I don't follow it, but I've heard of Momo. And then there's a bunch of other stocks that I've never heard of. So let's do Target. Okay, so TGT is a ticker symbol. So going back to my Ameritrade, let's put that in TGT. Now if I were to, this is the stock right here. Currently it's at $80.69. Let's look at the chart and see what kind of movement it has. So this is a year chart and looks pretty good. Nice uptrend in the last year. It's gone up a lot, so that's a good sign. 3 years, I see we got a little bit more volatility over the 3 years, but at least over the last year it's good enough for me. So if we go here to the earnings, you can see that earnings come out August 22nd, just like it said on the website on Yahoo. So what you do if you want to do a strangle is you go to the option chain and you start looking at the calls and the puts. Now if you look at this option chain as we go down and down and down, notice how the dates are different. Those dates tell you how long until the stock option expires. Now a stock option is a contract to buy or sell the stock at a set price. When you buy a stock, you're buying shares of the company. When you buy an option, you are buying a contract to buy or sell the shares of that company. Now you may ask yourself, why in the heck should I buy an option? Why not just buy or sell the stock? And the answer is the premium. Okay, and so calls, which are here on the left, those are contracts to buy the stock, and the puts, which are over here, those are the contracts to sell the stock. Now let's say, before you even get in a strangle, let's say you just believe that Target was going to go up. So right now, Target, its last price is $80.69. So if you wanted to buy, let's say, 100 shares of Target, you would need over $8,000. You'd need $8,069 to buy 100 shares of that stock. Okay? Or, so you could put up all that money, or you could very simply buy a call option, which means now you own a contract. And notice how there are different numbers there, right? Those are the prices that you can buy the stock at. These are the calls. The puts are over here. If you thought the stock was going to go down, you'd be looking at the puts. So these are the calls, right? And so instead of spending $8,000, right, you can spend a whopping, the bid is $2.65, the ask is $2.88, and one contract, one call option equals 100 shares. So you would move the decimal point, and it would cost you somewhere in between the bid and the ask. So it would cost you about $275. So what do you think? Would you rather spend $8,000 to own 100 shares of Target, or would you rather spend $270? I don't know about you, but for my money, I would much rather spend $270. And then I get to own that stock, or I'm sorry, I own the call option, which gives me the right to buy that stock between now and the next 8 days. Now if I wanted to give myself a longer time period, I'd go a month out. And now the price goes up from 200 whatever to, the bid is 335, the ask is 360, so the middle would be like 350. So again, if I wanted to buy 100 shares of Target, I'd have to put up $8,069. Or I could buy a call option, which is a contract to buy Target at $80 for $350. So would you rather spend $350 for a contract, or would you rather spend $8,069 for the stock? Okay, so to me, it's a done deal. I will never, well, I can't say I'll never buy stock. I do buy stock, but I buy and sell these stock options much more than I buy the actual stock. The only reason I ever buy the stock is if I'm bullish in the long term, and even then I would buy some put option as a way to protect myself, because if you buy a stock and then you buy a put, which is a contract to sell the stock, now if the stock goes down, you like let's say I bought Target at $80.69. If the stock goes down and I bought this put option, let's say it goes down 10%, 10% of 80 is $8. So if it went down to $72, then this put option would go up in value, and 80 minus 72 is 8. So it would be worth at least $800. So that's very good protection. You would not lose that much money by doing stuff like that. But that's a different kind of strategy. Today we're talking about strangles, and this is a quick review on the basics of calls and puts. So again, that's the reason why you buy and sell stock options, because you don't have $8,000. You don't want to put up all that money, and instead of doing that, you buy a call option for a whopping $350. Now, this price that you spend for the options is called a premium. Okay. Now, a strangle is when you would simultaneously buy a call and you would buy a put option on the same stock. So now you're buying a contract to buy the stock and you're buying a contract to sell the stock. Now, as convoluted as that sounds, that actually is a very good idea. That's why you can go on Investopedia.com, and I'll even do it just to show you. You can go on, there you go, Investopedia.com, and if I put in search strangle up there in the upper right, there you go. Okay, strangle is a well-known option strategy, and it involves a call and a put with different strike prices but the same maturity. Maturity means when does it expire, and the same underlying asset. That means the stock. Okay, so you're buying a call and a put on the same stock, and both the call and the put expire at the same time. That's all that means. Okay, so it's a very well-known strategy. And so now we're in Target. Now remember, Target, we looked at their earnings, is coming up in a week. So let's say I believe Target is going to go up or down. I don't know which way, but I think it's going to go up or down, maybe 5% or whatever in the next week. So I would look at a strangle. Now I would go 8 days out, because 8 days from now takes it past earnings. Earnings is on a Wednesday, and the 8 days is on a Friday. So I would look at calls and puts. Now what I would do is I would look at some of these cheap ones, and now I'm not going to buy these long terms. When I first started doing strangles, I was buying these long terms and I didn't make a lot of money. I did make money, but I didn't make a lot. So now I've learned that the best thing to do is to look for low priced options, and you're making a bet that Target or whatever stock is going to go up or down on the day of the earnings. So what I do is I would look at buying this $81 call. The bid is $212, the ask is $232, so $222. And then I would look at this put option for $80.50. And so the bid is $219 and the ask is $239. So if I just wanted to do one, then I would spend $222 plus $229, so for a total investment of about $450. I own contract to buy the stock and to sell the stock. Now that sounds convoluted, but it's very wise, because let's say I just thought the stock was going to go up and I didn't do a strangle and I just bought the call. I spent $222. Now let's say I'm wrong. Okay, let's say the earnings are bad and Target goes down 10%, goes down to $72. Now if I would have bought 100 shares of Target, I would put up $8,069. Target goes down 10%, so it goes down to $72. That's $8 a share. I own 100 shares. 8 times 100, I lose $800. Now if I bought the call option, I only lose this premium. I only lose $222, and that's the name of the game. That really is the name of investing overall. Real investors, they keep their losses small and they keep their profits big. Okay, you can't really do that buying stock, but you can completely and totally do that with options. Okay, so if I would just buy a call, if I just thought that Target was going to go up, I'd spend $222, and the worst case scenario is I lose $222 in the next 8 days. Not a big deal, especially in my case. In my Roth IRA here, I have 28 grand, so that barely even makes a dent in my bank account here. So going back to Target here, and going back to our option chain. Okay, now same thing with the put. With the put, now I'm making a bet that the stock's going to go down. Okay, now I would buy this put option here for $80.50, contract to sell the stock at $80.50, and if Target goes down, then I make money. But if it goes up and I'm wrong, if it goes up to $90, let's say it goes up a lot, then I lose $220. Now if you short sell the stock, then you're going to lose like $1,000. Okay, so these stock options, the premium is the name of the game. The premium, which is how much the option is worth, that's the reason why investors make money on buying and selling stock options. It's not quite as easy, unless you're Warren Buffett. It's not quite as easy to make money buying and selling stock, but it is tremendously easier to make money buying and selling the options. Okay, and so I've shown you a good example why, hands down, you want to be a stock option investor. Don't just do stock. Okay, because this premium, you could lose a little bit of money, but you can still make the big bucks as if you own the stock. Now, strangle means you buy a call. So I would buy this $81 call for $222, and I would buy a put for the bid $219, the ask $239, and I would buy the put for $229. Okay, and that's called a strangle. And the reason why this particular strategy makes money is because of this premium. Okay, when you buy a stock option, the most money you can lose is this premium. So if you just bought a call and you thought target was going to go up and you're wrong, then yeah, you lose $222. But that's it. You don't lose any more money other than the money that you spent on the call. And likewise with a put, if you thought the stock was going to go down, you'd buy a put option contract to sell the stock. Now if you're wrong and it goes up, most money that you can lose if you bought this put option for $80.50 is $229. Okay, if you short sell the stock, you could really lose a lot of money if it goes up. But with puts, you cannot lose more than the premium, the money that you spend on the option itself. And that's the idea. That's the basic idea of a strangle. Now, when you do a strangle, you're picking different strike prices. Now, if I bought the same $80.50 call, $80.50 put, that would be called a straddle. It's the same basic idea. You don't have to try to memorize all of the terminology and all the vocabulary. Just know and understand the basic idea of what you're trying to do. So you have a belief that between now and the earnings, target is going to go up or down one way or the other. You don't know which way, but you think it's going to go up or down. And just today, it went down 2.41%. So you probably would have made money if you set up a strangle yesterday. You'd be up probably a little bit, you know, maybe $50 or something. Okay, so between now and the earnings, which is August 22, you think it's going to go up or down. So what you would do is you would buy a call option, you click on the price, and then you put in your buy to open order, and then you put in whatever contracts to, and then click the review order, and you spend X amount of dollars, and you click the place order, which I'm not going to do. And then you do the same thing with the put, and you go to your put, click the price, click on the option, again, buy to open. You can do as many or as few contracts, you know, depending how much money you have and how gutsy you are. So again, you'd put it, let's say we did 2, click the review order, and that gives you an idea how much money you spend. So look how small money you're spending to invest in these options compared to if you're buying stock, like you're Mr. Buy and Hold and you want to diversify, you want a dollar cost average. Well, that's great. Okay, have a good time putting thousands and thousands of dollars in these stocks, while me, because I'm an option guy, I put in a fraction of the money that you would put in buying these stocks, and yet I'll make the same big money if it goes up, but if it goes down, I lose a fraction of the money that you will lose if you were to actually buy the stock. So stock options are infinitely less risky than stock for all of those reasons, and I will be a stock option guy until the day I die. I enjoy it. I certainly enjoy making money, and I'm having a good year. So back to the strangle. So you buy some calls and you buy some puts. Now, how exactly do you make money? Well, in order to make money, first of all, I'm going to click on all. So this is about to get really big. There, this is getting really big. Don't panic. You see the colored areas and the colored areas on the puts? That's approximately where the price of the stock is. So it makes it easy so you don't have to go up to the top and look at the last target is at $80.69. You can go right here and you can see the difference color, and you can see $80.69 is between this $80.50 and $81 call. Same thing here, $80.50, $81 put. So how do you make money? And I pulled this up on purpose to show you how you make money. Okay, now normally when you buy a call, the way you make money between now and this is for 8 days is in the next 8 days, this call would have to the price of target would have to be more than this $81 plus the premium. So $2.22, that would mean that target between now and the next 8 days would have to go to what do we say, 222. So target would have to go to $83.22. Right now target is at $80.69. So if it went to $83.22, that's like a $2.70 move, which is about a 4% uprising. Now, for the put, you do the same thing, except you do it the other direction. So if you were to just buy a put and you spend, excuse me, you spend $229, then you take $229 and subtract it from this $80.50 put. So if you wanted to make money on the $80.50 put, the price of target would have to go down to $78.21. So that would again be a drop of about $2.30 something. So again, it's about a 3% move. That's, and same with the call. I was off a percent. So Twitter would have to go down 3% or up 3%, depending if you have the call or the put. Now, because you're buying both, that means Twitter has to move. I keep saying Twitter, Target. The reason I keep saying Twitter is because number one, it sounds like Target, and number two, I have most of my money in Twitter. Okay, Target. Okay, the way you make money is because you're buying calls and you're buying puts. Target, not Twitter, Target would have to move more than if you just had the call. Now, if you're Mr. Confident and you have crystal ball and you think you know which direction it's going to go, then it would be better not to do a strangle and just buy the call or the put. If you thought it was going to go up, you buy the call. If you thought it was going to go down, you buy the put. But if you're like me and you don't have a crystal ball, then you get both of them. And the idea is because earnings is coming up, then that gives me a belief that Target is going to go up or down significant. So if it went up 5%, let's say, that would be a $4 move, and you would make a little bit of money. Now, if it went up 10%, you would make even more. Now, just to show you where does Target need to go to make money, you are spending a total of $222 for the calls and $229 for the puts. So $222 plus $229 is $451. I'm doing all this in my head because I'm too lazy to get a calculator. So 222 plus 222 is 444, and then you add another something, so 449. So let's say 450, just to make the math easy. So Target would have to go up or down $4.50 for you to make money on the entire position. Now, that is not a big deal. That's about a 5% move. Okay, so Target went up $4.50 to $85. You're going to make money. If it goes down $4.50 to $76 approximately, you will make money. If it does that like right away, like in the next day or two, you'll make even more money because you'll still have some time left, some time value left on these options. So you'll make even more money. So that's the basic idea of a strangle. Okay, with a strangle, you believe the stock is going to go up or down. You don't know which way, but you think it's going to go up or down because earnings is coming up or whatever. You know, whatever's going on. There's trade wars. you know, Donald Trump is a madman, whatever you think is going to make the stock go up or down, but you don't know which way, then you would buy a call option and a put option simultaneously. And the reason why this is a money-making strategy is because you are spending a fraction of the money to buy a contract than if you were to buy 100 shares of the stock. So learn these stock options. Don't waste your money, $8,000, buying 100 shares of Target when you can buy calls for like 200 bucks, or you can go further out. Like these calls out here are only 50 bucks, right? Cheap, 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 right? But you do have to have some discipline. I mean, you don't want to go hog wild, and if you have $10,000, put all $10,000 into a call or a put and buy umpty zillion call options or puts. You don't want to go crazy like that, but you want to be sensible. Take part of your money and buy some calls, buy some puts, and you can make money doing these strangles. So if you stuck with me watching this video, I thank you for watching. I'm planning to do another video here, and in the next video I want to show you something that I did personally just to keep track, almost like a schedule, like a 9-to-5 job, on a weekly basis. I made a watch list, and I will show you what I did, how I did it, and almost like you're a business owner, like you own your own business and you have a schedule. You know, on Monday you do this, on Wednesday you do that, on Tuesday next week you do that one, on Thursday you do this. That's kind of what I've done with these strangles, because one of the things about strangles is that especially in today's economic culture, economic climate, there is pretty much always going to be a market for strangles, because there's so much volatility going on in the world right now, and that creates lots of money making opportunities. So I thank you for watching, and I will see you in the next video. Have a good day.